Most people think politics is noise, but the price of your groceries, your mortgage rate, and whether your savings grows or shrinks, that's not noise. So the real question is, what happens when the global money system shifts quietly over years? Welcome back to The Passive Path. Today we're talking about the big picture money backdrop that most people ignore until it hits their wallet. And to make this practical, I'm bringing on a guest, fictional on purpose, who represents a careful, calm way of thinking through these ideas without turning it into doom or hype. Thanks for being here.
Happy to be here. And yes, fictional guest, real conversation. My goal is simple. Help people see the mechanisms, the incentives, and the patterns without pretending we can predict the future.
Good, because the internet loves certainty. Let's start with the core claim people repeat. Everything depends on the big picture. That can sound dramatic. What do you mean in a grounded way?
In a grounded way, it means this. Money flows are not random. Interest rates, currency strength, trade balances, and risk sentiment shape where capital goes. You don't need to follow every headline, but you do want a mental model for why booms and busts feel synchronized across countries.
So it's not politics, it's incentives and plumbing.
Exactly. When the cost of money changes, like rates rising or falling, it changes behavior everywhere. Consumers, businesses, governments, investors.
Okay, walk me through a pattern people felt recently, 2020-21, then 2022. In simple terms.
In 2020, the world got hit with a major shock. Growth collapsed, uncertainty spiked, and policymakers responded with aggressive support. That included very low interest rates and a lot of liquidity. Cash moving into the system to prevent a deeper collapse. When money is cheap and plentiful, people borrow more, invest more, and take more risk. That tends to lift asset prices, stocks, real estate, and sometimes more speculative things too.
So everything went up, period.
Broadly, yes. Then, as inflation became a problem, the cost of money rose. Higher rates changed the math. Borrowing gets expensive, safe yields look better, and global capital often shifts toward the currency offering higher return, especially if that currency is seen as stable.
You're describing why rising rates can pull money back toward the US dollar.
Often, yes, that's not a moral statement. It's an incentive statement. If you can earn 4 to 5% on short-term instruments with perceived safety, a lot of money rebalances.
So what happens to everyone else when the dollar strengthens?
Several things can happen. Imports priced in dollars become more expensive for countries with weaker currencies. Dollar-denominated debt becomes harder to service, and risk assets can fall because the discount rate went up and liquidity went down.
This is where people start using dramatic language, like the system is designed to trap you. How do you keep it factual?
By focusing on structure instead of villains. The US dollar has a special role in the global system. Trade invoicing, reserves, commodity pricing, cross-border debt. That creates a network effect. Lots of people use it because lots of other people use it. And network effects can be self-reinforcing, even without a single mastermind.
Let's talk about one concept from the transcript. Petrodollar. People throw the word around like it explains everything.
The idea historically is that oil trade has been widely priced in dollars. If a country needs oil, it often needs dollars to pay for it directly or indirectly. That contributes to global demand for dollars, especially when energy is central to the economy, which it is.
So if many commodities are priced in dollars, countries want dollars.
Yes, and not just countries, companies too. If you're an airline buying fuel or a manufacturer buying inputs, dollar pricing matters.
Now the transcript frames this as that's why the US can print forever. Do you agree?
I'd phrase it differently. Reserve currency status can lower borrowing costs and increase flexibility, but it's not magic. If a country abuses trust too far, investors demand higher yields, diversify, or reduce exposure. So there's power, but also constraints.
That's important because the listener is thinking, okay, but what do I do with this?
Right, because knowing the plumbing is only useful if it changes your choices.
Before we go practical, I want to address a pattern the transcript emphasizes. Cycles. Cheap money, then expensive money. Risk on, then risk off. What's the cleanest way to explain that cycle?
Here's a simple mental model. When rates are low and liquidity is high, The system encourages expansion, borrowing, investing, hiring, building. Over time, that can overshoot, prices rise too fast, leverage builds, inflation appears, bubbles form in pockets, then policy tightens, rates rise, lending standards tighten, speculation fades, and weak balance sheets break. After the pain resets excesses, policy eventually eases again.
So it's not a conspiracy, it's a feedback loop.
Yes, but here's the uncomfortable part. Even if it's not a conspiracy, it can still feel unfair because institutions with cheap capital and professional risk management can survive downturns and buy assets when others are forced to sell.
That's the sell low, buy high tragedy.
Exactly. A normal person loses their job during a downturn, sees their portfolio down, sees headlines screaming, and sells to feel safe. Meanwhile, someone with stable funding buys the same assets at a discount.
Can we make that concrete?
Sure. Imagine two households. Household A has a 6-month emergency fund, low debt, and steady income. Household B has no buffer, high payments, and income that's sensitive to layoffs. When rates rise and the economy slows, Household B is forced to cut spending and maybe sell investments or even property. Household A can hold, maybe even add. Same market, totally different outcome.
So the big picture matters, but the personal balance sheet matters more.
Yes, macro sets the weather. Your financial habits decide whether you get soaked.
Nice. Now the transcript moves from this system view into so people are de-dollarizing. How should a regular person interpret that?
They should interpret it cautiously. Some countries talk about settling trade in other currencies, increasing regional payment systems, or reducing reliance on one currency. That can be real in specific corridors like bilateral trade agreements, but replacing the dollar globally is a huge, slow process because of liquidity, trust, legal systems, and market depth. So you can watch the direction without assuming a sudden flip.
So it's a drift, not a switch.
That's a good way to put it.
And in the transcript, your drift leads to one big action: central banks buying gold. Is that a reasonable connection?
Gold has historically been one of the assets central banks hold as a reserve diversifier when geopolitical risk rises, or when countries want to reduce dependence on any one counterparty. Gold sometimes looks attractive because it has no issuer. It's not someone else's liability.
That phrase is important. No issuer. So let's shift to the question the audience is actually here for. Gold. Should normal people care?
They should care in the same way they care about insurance, not because you want your house to burn down, but because you want resilience. Gold is not a productivity asset like a business. It doesn't innovate. It doesn't pay a dividend, but it can play a role as a hedge in certain scenarios: inflation shocks, currency stress, crisis periods, and broad loss of confidence.
The transcript also says gold is easy to understand and there's a once-in-a-lifetime opportunity. That's where I want you to slow down and de-hype.
Absolutely. Anytime someone says once in a lifetime, your brain should automatically ask, compared to what? And based on what evidence? Gold can trend up for years. It can also go sideways for years. It can drop sharply. It's not guaranteed. The practical use is not prediction, it's portfolio design.
So gold is not a lottery ticket.
Correct. If you want lottery, just admit it's lottery. If you want stability, gold is part of a broader strategy: savings, skills, diversified investments, and sane risk.
Let's address one of the most useful points in the transcript. People buy gold and still lose money. How?
Because they didn't buy gold exposure, they bought gold jewelry. Jewelry includes design premiums, labor costs, retailer margins, sometimes poor resale spreads. So the moment you buy it, you're already down because you can't resell the craftsmanship at full value.
So what should people buy instead if they want gold as a financial asset?
In general terms, you want lower premium forms. That can mean widely recognized bullion coins or bars from reputable sources. Or for some people, gold-backed ETFs or funds, though those come with different trade-offs like management fees and counterparty structure.
You're not giving a one-size-fits-all instruction.
Right, because the best choice depends on your goal. If your goal is crisis insurance, some people prefer physical. If your goal is easy liquidity and rebalancing, paper instruments are convenient, but you should understand what you own.
Okay, now the other key point, time horizon. Gold can look bad short-term and good long-term.
Yes, people make a classic mistake. They look at an average annual return and assume it's smooth. It's not smooth. Returns come in bursts, and long flat periods happen. So if you buy gold hoping it pays you next month, you're basically trading sentiment. If you buy gold as a long-term diversifier, you accept that it's not always exciting.
Give me an example with human behavior, not charts.
Sure, person one buys gold when the world feels calm, because they're disciplined. They keep it small, consistent, boring. Person two buys gold after a scary headline because they feel panic. They buy a lot at once, near a spike. Then the headline fades, gold cools off, and person two sells at a loss. Person one forgets about it and keeps building their base.
So the gold strategy is actually a behavior strategy.
Exactly. Most investing outcomes are behavior outcomes wearing a finance costume.
Now, I want to introduce a practical framework. If someone wants to include gold, what's a reasonable way to think about sizing?
Think in layers. Layer one is survival, emergency fund, stable cash flow, manageable debt. Layer two is growth, broad diversified assets you understand, held for years. Layer three is resilience, small allocations that are meant to behave differently in stress. Gold can live here. The point is, don't buy resilience while your survival layer is weak.
So if you have credit card debt at 20%, gold is not your hero.
Exactly. Paying down toxic debt is a guaranteed return. Gold is not.
The transcript also moves into people get tricked into holding cash at the wrong time. What's the simplest version of that lesson?
Cash is a tool. It gives you flexibility. But holding too much cash for too long during inflation quietly bleeds purchasing power. So the mistake isn't cash. The mistake is unplanned cash.
Unplanned cash.
Yes. If you're holding cash for a down payment in 18 months, great. If you're holding cash because you're scared, with no plan, you'll likely buy back into risk later at a higher price.
That's the loop. Now I want to return to a claim from the transcript. When rates rise within 6 to 12 months, big players buy assets cheap. Is that always true?
Not always, but the dynamic exists. When financing costs rise, weak borrowers struggle. Distressed sellers appear. People who must sell, not want to sell. Those are the moments where strong balance sheets can acquire assets at better prices. But timing it perfectly is hard, and you shouldn't try to.
So what should a normal listener do instead?
Design your life so you're not a forced seller. That's the whole game. If you have buffers, low fixed costs, and diversified income, you can hold through volatility. You don't need to predict the rate decision next quarter.
This is where the passive path always returns. Build the engine.
Exactly. Your engine is your earning power, your skills, your habits, and your ability to produce value. Once your engine is strong, investing becomes calmer because you're not relying on one fragile asset to save you.
The transcript ends with a big pivot. The most important investment is yourself. That can sound like a cliche. Make it real.
Yes, because the world changes fast. Industries that looked permanent can shrink, and the internet made global competition real for many jobs. So being adaptable is financial security.
Let's turn that into a listener-friendly checklist. If someone is worried about the system, what are the first 5 things they should do?
Build an emergency fund that matches your risk. Start with 1 month, then 3, then 6. 2, reduce high-interest debt aggressively. 3, stabilize income. Add 1 extra stream, even small, even boring. 4, diversify investing. Broad index exposure or diversified funds you understand, held long-term. 5, add resilience tools only after the basics, maybe a small gold allocation, maybe inflation-protected instruments, maybe simply more cash during a known transition period.
And the O, maybe, is doing a lot of work.
It should, because finance isn't a religion. It's trade-offs.
Now, I want to address a psychological piece. A lot of people watch macro videos because it gives them a sense of control. What's the healthy way to engage with this?
Use macro as a map, not a prophecy. A map tells you terrain. It doesn't tell you the exact weather at 3:17 p.m. next Thursday. If macro content makes you panic, it's not helping. If it helps you diversify, reduce fragility, and avoid obvious mistakes, great.
What are the obvious mistakes you see most?
Chasing what just went up, using leverage because it worked in the last cycle, buying safe assets without understanding inflation risk, making concentrated bets based on a single narrative, and not having a plan for volatility.
Let's give one example that ties it all together. Say someone in Finland is listening, or anywhere, really. They've got some savings, a mortgage, and anxiety. What does plan look like?
Plan looks like written decisions. If my expenses are X, my emergency fund target is Y months. If rates rise further, I can still pay the mortgage because my fixed costs are under Z% of income. If markets drop 30%, I won't sell. I will keep contributing monthly. If I want gold, it's a small percentage, purchased in low premium form, not jewelry, and I hold it for years. I spend 2 hours a week building skills or a side income, so my future isn't one paycheck.
Written decisions. That's the difference between investing and reacting.
Exactly.
Before we close, I want to ask you the hard question. If someone believes the world is shifting away from the dollar, what does that mean for them today?
Today, it means humility. The dollar is still central, but diversification is sensible. It means don't build a plan that only works if one macro narrative is true. Instead, build a plan that works if inflation stays sticky, if growth slows, if markets rally, if markets crash. That's resilient investing.
So you're not betting on a headline.
You're building a life.
All right, let's land this. If I summarize your message, it's this. Macro matters, but it's not an excuse to panic. Cycles are real, and the winners aren't the profits. They're the people who aren't forced to sell. Gold can be a tool, not a religion. Avoid jewelry premiums, respect volatility, and size it like insurance. And the real hedge is your engine, income, skills, low fragility, and a calm plan.
That's exactly it. If someone takes one lesson, I hope it's this. Don't outsource your peace of mind to predictions. Build buffers, build skills, diversify, stay calm.
Love it. Thanks for joining us on The Passive Path.
Thanks for having me. Take care, everyone.